In this video, we will very briefly look at the layout or the format of financial statements. Now, it is vitally important that you know these formats out of your head and that you would be able to fill it in completely, because it might be partially completed for you in a question paper. So therefore, it's very important that you sit down and you study this out of your head so that you can fill this in a question paper. So at the end of every financial year, the financial position of the partnership must be reflected in the form of a financial statement that conforms to the standards of GAAP, generally accepted accounting practice and principles. So therefore, when we look at the first financial statement, it is the income statement. Now, from grade 10 to grade 11, the income statement does not change at all. So if you studied this layout last year, then you do not need to study it again this year. So the income statement of Brooklyn Stores for the year ended 28th February. So it's not a financial statement on a specific date, but it's for a year. So it's for an entire period. We always start off with net sales minus cost of sales gives us our first profit, which is known as the gross profit. Just remember, your sales needs to be sales minus debtors allowances. So the same way that we did it when we did our closing transfers, the same needs to apply to when we do our income statement. Then our gross profit plus any other incomes. So then you can list any income that can add to your gross profit, but it would not be your interest expense because interest income is right at the bottom of the statement. That would then give you your gross operating income, so that's your gross profit plus your other operating income. So it gives you a gross operating income. Your gross operating income then subtracted from that is your expenses. So again, I would subtract all of my expenses except for my interest expenses listed at the bottom of the statement. So all my gross operating incomes minus expenses gives me my second profit, and that is the operating profit. Now after operating profit, you find your two interests. Now interest income is calculated in note number 1 and interest expense is calculated in note number 2. So if we go to the notes, in our interest income note, I simply list all the different interest incomes that I find. I list their totals and then I add them up, and my added up total is what I take back to my income statement as a total for interest income. I do the same for interest expense. I list all the different types of interest expenses I find. I put their amounts down, and then the total that I've got, I take that total back to my income statement. Then after that, you will find your third profit, which is the net profit for the year. Just one thing that you must please note, and it's a good thing if you teach yourself from the start to fill in these brackets. Cost of sales, operating expenses, and interest expenses are things that are decreasing my profits, so therefore they need to always be shown in brackets. If you do not show them in brackets, then you will lose marks for it. Now for our second financial statement, and that is the balance sheet. So the balance sheet is done according to our accounting equation, which says assets are equal to owner's equity plus liabilities. So therefore, this accounting or this financial statement first lists all of the assets compared to owner's equity and liability. So then total assets needs to equal to total equity and liabilities. And if that happens that it is so that it is in balance, then I know that throughout the year I have applied my accounting equation successfully, and therefore I am now in balance at the end of the year. So when I look at my assets, I have two types of assets. I get non-current assets and I have current assets. Non-current meaning long-term assets. Current assets meaning short-term assets. So assets that will be part of my business for a long time, and assets that will be part of my business for a short period of time. So when I look at my non-current assets first, I find fixed assets is done in note number 3. Now remember, note number 3, very important note. We've already done that in term 1, so I'm only briefly going to look at note 3. That's your fixed assets note. So fixed assets notes start off beginning of the year. It looks at your 3 movements throughout the year, and it ends off with your balances at the end of the year. Now remember, what we are looking for is our carrying value total at the end of the year, and this is the amount that I will take back to my balance sheet, and I will fill into my balance sheet next to fixed assets. Then also part of non-current assets is financial assets. So those are typically your fixed deposits, and those are your fixed deposits that will not mature within the next financial year. So it needs to be a long-term fixed asset if you want to place it under long-term assets. Then the next area is your current assets. Now remember, current assets, very important, was placed in this specific order of liquidity. Meaning that liquidity says, how easy can I change these assets into cash? In other words, liquidate my assets to become cash for the business. So the easiest to liquidate to cash is cash and cash equivalents, because it's already cash. The second hardest is your trade and other receivables, because remember, it's already cash, but it's still in someone else's possession. They must still pay it over to us. And then the most difficult, thirdly, is inventories, and that's why I place it right at the top, because it's the most difficult, because I first need to still find a buyer for these goods, then they come in, they buy it, and then only I will have cash. So that's the most difficult for me to convert back to cash. So you must place it in this specific order. If it's placed differently, you will lose marks for it. So therefore, inventories, note number 4, trade and other receivables, note number 5, and cash and cash equivalents, note number 6. Let's go and look at those 3 notes. So my first note, inventory, is very easy. What is inventory in my business? That's only trading stock and consumable stores on hand. Then trade and other receivables. What is that? That's all the people that owe me money. So that's my debtors, but minus the provision for bad debts. So in other words, I only work with the net trade debtors. Then also my prepaid expenses, as well as my accrued income, or also known as income receivable. And then if there is a deposit on water and electricity, I would also add it to trade and other receivables. My total that I find here then is the total I take back to my balance sheet. Then note number 6, cash and cash equivalents. Anything that's cash in the business or that will be cash within the next year. So bank is my main one. Savings account, cash flow, and petty cash are normal ones. And then I can also add fixed deposit, but only if my fixed deposit matures within 12 months. I will also place it as a cash and cash equivalent. Again, I add it up, and then the adding up will go back to my balance sheet as my total amounts for current assets. My current assets plus my non-current assets gives me my total assets for the year. Now let's look at the second section in my balance sheet, and that is the equity and liabilities. Firstly, looking at owner's equity. So in other words, that's the partner's equity in the business, and there's 2 types. You find their capital as well as their current. So capital is calculated in note number 7, whereas the current accounts are calculated in note number 8. So when we go to those 2 notes, those are obviously new notes to partnerships, so obviously very important for grade 11. Capital note is a very straightforward and simple note. starts with the balance beginning of the year and then ends with the balance end of the year. So what can change my balance from beginning to end? Only two things. I can either contribute more, or they could have withdrawn some of their capital. So therefore, adding if they contributed more capital, and subtracting if they withdrew. So therefore that then ends with the balance at the end, and I obviously don't want partners A's, I don't want partner B's, but I want the total for all of them together at the end of the year, and that's what I would take back to my balance sheet. Out of all of the notes, note number 8, the current account note, is the most popular one to be asked and also the most difficult one to fill in. So the same thing that applied when you completed the accounts for the partners, the same steps needs to be followed here, especially the steps followed by doing the appropriation account. So I will start off with my net profit beginning of the year according to income statement. So that 60,000 is the total net profit according to income statement. So the net profit that you saw there at the bottom of income statement is the net profit to be taken to your note 8. Then this net profit is now distributed first according to primary and then according to final. So I list my primary distributions and I would then add them up and see that my total primary distributions is 40,000. So therefore of my 60,000 net profit, I've already distributed 40, so therefore there's only 20 left to distribute, and that I then distribute according to final in terms of the ratio. So then my primary plus my final gets added up and taken to the top part as part of your how you distributed your net profit according to income statement. So after you've distributed all of your net profits according to primary and final, these two amounts should equal back to the total net profit that you've got. After you've distributed all the profits, you will then work out what is the retained income. Now, retained income means what is the income left by the partners inside the business, or in other words, kept by the business from the partners' profits. So the 26,000 income earned minus the 15,000 drawings taken tells me that this partner has left 11,000 Rand within the business. I'll do the same for partner B. I can do the same then in the total column. This retained income is then just added to the income from the beginning of the year to find my new balance for each partner according to end of year. Remember, this needs to then be corresponding with the actual current accounts in the general ledger. What do I need to take back to my balance sheet? Is this retained income at the end of the year, the total for both partners. So 33,000 is taken back to the balance sheet as your current account amount at the end of the year. The final part then of this balance sheet is the liabilities. So non-current liabilities and current liabilities. Again, long-term liabilities versus short-term liabilities. So long-term liabilities is your mortgage loan. And then current liabilities would typically be your note number 9, as well as any installments on the loan due within the next 12 months. Or if your bank is in overdraft, you would also put it as a current liability. When you consider our last note, trade and other payables, note number 9, that then is a summary of all the people that we owe money to for the next financial year. So therefore, creditors is obviously forming a crucial part of this note. I can also still owe money on some of my expenses. I can also have income received in advance. And then if there's any money outstanding in terms of salaries and wages, such as creditors for salaries, pension fund, medical aid fund, SARS pay as you earn, those would also be listed as outstanding amounts or short-term creditors. Therefore, this total amount in trade and other payables is then taken back to your balance sheet to then form the last bit of the balance sheet that there needs to be done. So after you've completed this, your equity plus your long-term liabilities plus your short-term liabilities is all added together to get your total equity and liabilities. And then total equity and liabilities should match up with total assets, and therefore I then know that my accounting equation is in balance. Therefore my balance sheet is also in balance.